Ladies and gentlemen, welcome back to Walk the Block, where we are navigating digital finance all together. I'm your host for the evening, Zenith, and I am thrilled to be here with you here tonight. We're going to be talking about a handful of topics. We're going to be going, of course, over a market update, as everyone loves, and we got some cool economics data that we're going to take a look at as well. But the real story of the night is Robinhood. Yes, that financial app has officially launched a layer 2 blockchain, and we're going to talk about what that means, kind of how they fit into the space and what's going on. And then specifically, I do want to dive into what exactly is a layer 2 blockchain. There's a handful of different blockchains that operate as different kind of layers. Traditionally, the one that you probably know and love best is a layer 1, and we're starting to see an uptick in layer 2s. So I figured there's no time like the present to talk about what exactly is going on with those, what that means for the overall ecosystem, and who wins, who loses, and who just honestly doesn't care. With that being said, happy Thursday to everybody. I hope you're all having an excellent day. I'm doing pretty well myself. Got a fresh cut, got a new chair. Granted, I kind of went with the office special, but you know what? It's good for the back, and yeah, we're getting a little older, so we need that. Anyways, tell you what, let's dive right into it. So let's take a look at the market. Let's see what's going on. Ba-ba-da-ba. There we go. Alrighty. So Bitcoin currently sitting at $63,607. All right, not a terrible price, but the interesting news of note since the last time that we spoke about 7 days ago is that we actually went up above the 50-day moving average, and right now we are sitting like dead smack on it. Okay, what does that mean exactly? Well, your moving averages are your indicators of overall momentum in the short, medium, and long term, depending on how long they are. So on the screen here, the teal one, that is going to be our 20-day. This blue is our 50-day, and this purple up here is our 200-day. That is your short, middle, and long-term momentum indicators. We got above the 20-day moving average. Very cool. We saw a retest. We actually saw 2 retests. That second retest was one of the things that came in the last few days. And we went from that retest and absolutely exploded up through this 50-day moving average. And we actually had a close above it and then one close below. And now we are currently sitting right below it as the candles are coming in as we speak. But what's interesting about this is that the question for the 60-day cycle that we're on right now, which, by the way, we are on day 42, has kind of been, okay, it appears we're going to have a down cycle, but is there anything that could make some noise, make some ripples going on here? And, well, we've kind of seen that, but we didn't quite see a potential explosion past that 50-day that we were looking for. So previously, our high was on day 10, back at about $67,000. After that, we dropped all the way down to 58 and then 57. Since then, we recovered, and our recent high is about $65,500. So, what we can take from this is that, yes, we are not above our previous cycle high here going on, but we are able to move suit through some levels and indicators that do act as resistances potentially. And I would love to have seen this rally keep continuing and just power right through there, but that's just not in the cards. We'll turn on our volume candles here so we can also see what's going on there. One thing of note is that, yeah, we have had some upwards trajectory, but the volume really isn't that large. This is probably an indication that, well, people are just not caring about crypto as it stands right now. And these prices in particular also are not ringing any alarm bells for people as well. As far as what's going on with the RSI, though, we are seeing more of this bullish divergence, I'm going to call it. Typically, what we were looking at is that this low, and this low correlates to here, here, and here on the RSI. This one is obviously lower, and these ones are higher, but the price was higher here and lower here. Pretty much, you got one line going down, one line going up. That shows that there's kind of an incongruence in the market. And as a result of that, we have seen some of that bullish action play out, and we're starting to build higher highs on the RSI as it stands. With that being said, though, I do want to go ahead and pull up this guy, the good old Bitcoin Fear and Greed Index, because, well, guess what? We're still very much in the bearish sentiment. And there's a good reason for it, too. We're just in the bear market at this point. It is what it is. If we look at the historical, this is the 3-month. Not a whole lot going on. Dropped all the way down to 8 and then almost got back into the single digits on the 1st of July. But since then, we've been creeping up. Really, we have not broken past this 30 mark in a hot minute. And if we look back at our chart, here's our 1st of July. That is our low right there. But then after that, we're still climbing up. And even though we are kind of almost where we were previously. The fear and greed index is not showing as much. So, what does this mean in the short term? Overall, we're looking at a 60-day cycle, or at least that's how I look at it, which is that pretty much every 60 days you have a cycle low. Granted, that does fall left or right depending on kind of just probability of what's going on in the world, the markets, and then also the overall shape of the cycle. Because we have already breached our cycle low from the beginning, I do expect the end of this cycle to fall below 58,000 dollars. And my time prediction is that's pretty much going to happen in the next 2 weeks because the day 10 high was very early on in the cycle, and we have not broken past that again. Unless we get above that $67,200 mark, that means that that's going to be our high. And in that case, I predict that, well, our 60-day cycle is going to cut a little bit short. Based on the math that I've run behind the scenes, you can kind of imagine that your first standard deviation of left and right is pretty much plus or minus 9 days from 60. So that puts us at 51. 51 would be, no, you go away. 51 is going to put us on the 26th of July. And then day 60 is going to be the 4th of August. So pretty much sometime between the 26th and the 4th, that's what I'm looking at that cycle low to come in. As far as what goes on between then, well, I would like to see maybe a rejection off this 20-day moving average and also the 50-day. That would be a very strong indicator. And well, if that's the case and we never actually get down back below that 57,000 level, that would really throw a wrench through my plans. And we would actually get what is called a failed cycle. They're very far and very few in between, but they can happen. As far as this one, I don't see any indicators going on in the world to indicate that such a black swan event is going to cause it to happen. But overall, more than likely, we're going to be back down here below that 60 mark, at least for just like a day or even a moment, even before it possibly recovers back to the upside to begin a new cycle. Overall, though, looking at the markets, there's some good news to actually go around. Ethereum is kind of the big winner, actually. The Ethereum to Bitcoin ratio has been going much more in Ethereum's favor. We're quite not at some levels that we were previously at in the last bull market and other times, pretty much in the last year or two. And it's still definitely suppressed. But overall, Ethereum blasting past that 50-day moving average and being decently above that 20-day moving average tells me in the short to medium term, this could keep going up. Typically, the rest of the market does follow kind of Bitcoin's pattern. But at the current time, it appears that Ethereum is actually doing pretty well. You could say it's off the backs of some other news that's been coming out with regards to the Ethereum Foundation, which we've covered pretty extensively on the channel over the last few weeks. The Ethereum saga will continue tonight a little bit, by the way. But I think Ethereum's having a decent little time. Granted, I'm not talking about like a face melting pump or anything, but I'm just saying when it comes to the indicators, it's sitting higher above the indicators than Bitcoin is. So that's good news. Let's take a look at some other stuff throughout the market as well. So taking a peek over at Solana, bit of a different story, closer to the Bitcoin narrative. Decent little high. This one's actually higher than the initial high that we had back in July, but overall, kind of sitting at this weird place between the 20 and the 50-day moving average. They actually crossed back over on the 8th of July. What that could indicate is a potential pattern reversal for a bottom, but at the same time, it could very easily go right back under it if the price also drops. $75 for Solana. It's actually not a terrible price, all things considered. Pretty much, we never saw below this like 120 mark for the entirety of 2024 and even most of 2025. Only recently did we drop back below it. As far as Solana's price history goes, we don't have a lot of data between this like 75 level and this like $50 level. So theoretically, if this drops, it could go back down to $50. And considering that the last bear market low was about $8, or more realistically, you had an opportunity to scoop it up at 12. It's still significantly higher than that. And I think that's it just goes to show how much they did in this last cycle and how well they held up. We'll take a peek at a few more here. Avalanche, my favorite private banking blockchain, currently sitting about $6.50. Definitely down as well. And to be honest with you, this looks more like a traditional altcoin chart when it comes to the bear market. We are looking for a bear market low. We are now in price discovery for new lows. So Avalanche, kind of been one of the big layer ones of yesteryear or current year, if you will. But overall, this is honestly probably a better representation of what I expect altcoin charts to look like and kind of mirror. And with that being said, let's take a look at a true altcoin, or rather a meme coin, if you will, Doge. Famously, Elon Musk's favorite token, currently sitting about 7 cents, and we're looking at this price floor of about 5.5 cents from the previous bear market. Granted, this one did not do nearly as well as people are hoping for, largely due to the lack of an altcoin season that, in my opinion, was based on the fact that Ethereum just did not perform. Therefore, altcoins didn't perform, and the rest of the market didn't. So, with that being said, are the chances that we could drop below 5 cents real? Yeah, they are. But at the same time, after that, there's not much price action or price history to look at, and we're going down less than a penny. So again, it is a pure meme coin. This is pure market psychology at work right here, and just exactly what goes on there. There's barely any news events that affect this other than like massive people like Elon tweeting about it. But as far as pure market psychology, this is honestly a pretty good little chart to study here. Alrighty, with that being said, we do have some important data that came in though. We got an unemployment and inflation data for the month of July. And by that, I mean it's data for the month of May. If you remember back about 30 days ago, and even a little bit longer, the major dominating story of pretty much the entire world was what's going on over in the Middle East with Iran and the United States. Yes, tensions have flared up back in the last 2 weeks, and we have started conducting strikes again. And the Memorandum of Understanding, the MOU, if you will, yeah, that didn't last very long. So I expect that that action is going to impact next month's report, which is really going to be the report for July. But with that being said, let's get into it. 4.2% unemployment rate, currently down from the high that we had back in November of 25 at 4.5%. The pattern is looking like we're sitting right at this like 4.0 level. We're starting to approach it. I wouldn't be surprised if maybe have like a tick up for the next month or something. But overall, it appears that we kind of have had this top. We topped out at about 4.5%, which means that, well, people are kind of getting back to work. It's not all rainbows, though, because, well, the where did it go? Labor force participation rate. This is a bit of a doozy, down to 61%. Let's see if, yeah, that's your labor force participation rate. You might note there's a bit of a trend going on, meaning that, well, people are kind of just opting out of the labor force, or rather, the institution that counts it is no longer counting them as part of the workforce. So that's a bit of bearish news on that standpoint. But overall, when it comes to the jobs report, I want to say it was about 57,000 jobs added for the month of June. There was a revision to May's numbers. They were revised down slightly, but still 130,000 jobs added to the economy during that period. That's still a pretty good report. So overall, I'm still pretty bullish on the overall economy here inside of the United States. Let's take a look at inflation. Classic. 4.2. We did get this report on Monday this week, the 14th, and the report for that one actually came in at about 3.5% year over year. So this one has not been updated from my chart, so there will be a small tick down here for the month of June. But again, it's kind of in line with everything else. Things are starting to calm down, especially because tensions in the Middle East was the thing that was driving inflation primarily just due to energy prices. And in fact, if you look at the core CPI, which I try not to pay too much attention to, but it's one of the stats they tout, that was actually flat, like 0% core inflation for the last month. At the same time, though, that does cut out food and energy, two of the largest costs that we have here in our daily lives. So it's kind of a moot point, as I say. But I guarantee you are going to hear that number touted about what's going on with the overall economy. 4.2 inflation. This is 4.2, and now our 3.5 number. This is still a lot higher than we want to be, but there's a very clear reason for it about why it is the way that it is and what's going on. So you can kind of explain it away, but at the same time, overall, I do wish it were lower. Speaking of inflation and all that stuff, let's look at the people who control that. This is the Federal Reserve. And yes, we actually have another FOMC meeting coming up basically in 2 weeks here. So I think we're about 12 days out right now, and we're looking at the 29th. That's the day that we actually get our press conference and we get the official release of the statement and the decision that they're going to make. And the decision that they're going to make currently as it stands is most likely no change. So we're going to flip over to FedWatch by CME Group. 88.8% chance of no change and 11.2% chance of a quarter point increase. If we head on over to Polymarket, we're going to see pretty similar thing. looking at 95.9% no change and only a 3.9% quarter point increase. Everything else is less than 1%, so it's not even registering. The reason that we're seeing this is obviously we have the new Fed chair, Kevin Warsh. And if you remember when we covered his first press conference about a month and a half ago, he was actually kind of hawkish about it. What I mean by that is that he was talking up the inflation game and saying that that is one of the number one things that they're trying to crush. The jobs reports were less concerning, but as far as inflation and prices go, the housing sector in particular was probably the one that he was most concerned about when it comes to the scale of the problem. Not necessarily if they have to act on it, but that was the area that he signaled as the one that probably could use the most help. But he did mention the overall economy is actually doing pretty strong as it stands right now. And well, I know we're expecting rate cuts this year, but as it stands right now, based on the data coming out and the new guy, yes, before he got in there, he was talking about three quarter point cuts over the course of the year, and now we're looking at possibly zero. And if things actually kind of keep going sideways, there might even be a slight increase as well. But time's only going to tell on that one. All righty. I do want to take a quick moment, say hi to all the boys. We got Wink Wright, aka Frank White, saying "Bang Bang Pulse Gang." Yes, sir. Good to see you as always. Pulse Chain might come into the conversation here tonight when we're talking about the difference of layer one chains and layer two chains. This is actually a great example that I do want to bring up. And then we also got my good buddy Centurion 54X. How you doing, Zenith? I'm doing well, sir. I hope you guys are all having a fantastic week. We're actually doing pretty well right now for any sports fans that are out there. I didn't realize it, but this last week was actually pretty phenomenal. We had Wimbledon going on, we had World Cup, quarterfinals, semifinals just happened recently. So it looks like we're going to get Argentina and Spain in the finals. And I want to say that's on Sunday. Then we also had big UFC event. And well, UFC event is over. We're winding down. And yeah, we might be entering that dead season. Ooh, I see we also got Moon Pilled Rational Optics sliding in here. Says, "What's up, buddy?" I'm just doing what we do, good sir. It is a pleasure to see you guys as always. So, tell you what, let's jump straight to the chase. What exactly is going on in the world of crypto here? Big shout out to everybody that caught the DGen Roundtable stream. That's the other channel I'm on. Oh shoot, Boogie's coming. Boogie's coming on. Boogie's also a good friend of ours as well. We like him as well. Robinhood, yes, that financial app that you know, maybe love, maybe hate, like us over here. They have officially launched a new blockchain. It is a layer 2 blockchain on Ethereum, and they actually are not using their own native token as the gas token. They're using Ethereum as the gas token, which is pretty common for layer 2s. But to give you the quick recap, one of the big things that is actually interesting about this is they paired up with Chainlink. Chainlink is a layer 0 blockchain, which kind of acts as the blockchain between blockchains. And it's been a bit of a darling, especially in the last cycle. Chainlink, I'm pretty sure, is sitting at about number 18 by total market cap as it stands today. It was very much a favorite of this last market, along with some others like Sui and just the various other altcoins that really popped up. Lately, it's been all the talk is around Monero, Zcash, all that kind of stuff. But Chainlink was one of the big winners of the 2025 cycle, we're going to call it. And they've partnered up with Robinhood. Robinhood famously is the app that kind of exists between both worlds. It exists to serve people mobily on phones primarily, and then also be your intermediary between the actual stock market. They also did get in on crypto, and you can actually trade crypto on there. When I say trade crypto, what I mean is that you can trade the price action of crypto pretty much because you don't hold your tokens. One, because it's a centralized exchange, but two, because it's also the way they operate. They don't actually take possession of all these things and earmark it for your account. So if you wanted to actually transfer your stock or your crypto to another account, it would require you to specifically request it. And then it's actually going to take a good amount of time to actually clear and get to that other account. So because of that, we've talked about this on the channel previously. As far as centralized exchanges go, Robinhood honestly is at a much lower tier than a lot of the other ones that are truly kind of crypto native. And the good thing about Robinhood, though, is that it does reach a lot of users. I'm going to go into the stats here shortly, but Robinhood, it's smaller when it comes to total assets under management. But as far as daily active users and total user base, it actually competes with some of the largest exchanges, both in TradFi and crypto, that are available here inside of the United States. But with that being said, what we're talking about here is that Robinhood is actually making the case that Ethereum is far from dead. This is your layer 2 story kicker here. Why Robinhood's chain strengthens the Ethereum bull case. Travis Kling, founder of Ikigai Asset Management, asked this week whether real companies have any interest in existing L1s and L2s. He pointed out that Robinhood, Swift, Stripe, and Wall Street's Canton as evidence that they prefer their own blockchains. Honest question. Robinhood has its own blockchain, Swift has its own blockchain, Stripe has its own blockchain, and Wall Street has its own blockchain. I will also add here some private banks, namely JP Morgan Chase, also have their own private blockchains on Avalanche. But this is pointing out an obvious trend that is going on pretty much today, which is that we're starting to see, instead of people adopting existing infrastructure, they're willing to go it on their own and actually build their own L2 blockchain. Granted, they're not building L1s specifically, they're building L2s because it's a lot easier because they're building on top of the existing L1 framework. Robinhood's architecture cuts against that premise. Robinhood is an Ethereum Layer 2, a separate network that inherits Ethereum security. Final settlement happens on Ethereum, meaning the main network holds the definitive record of its transactions. Its official bridge needs no third-party validators, and Ethereum is the native gas token. In other words, Robinhood did not reject Ethereum. It's rejecting sharing a chain with other projects, then chose Ethereum as the parent network of its own. The chain also casts a deliberate two-step strategy. Robinhood launched its first generation stock tokens on Arbitrum 1 in January of 2025, sets a demand on shared infrastructure for the year, then graduated to its own chain. From the Robinhood account, a new beginning for the future of finance. It's almost time to catch a token. Tune in as we live stream in Cannes, France, to make our biggest crypto announcement of the year. This is pretty much when they did announce, or actually re-announce, the launch of their blockchain. They teased it in the past and they officially launched it. And it's been live for about 2 weeks now. The public testnet processed more than 200 million transactions before mainnet, per the Arbitrum Foundation. The commercial logic mirrors Coinbase's decision to build Base, an Ethereum Layer 2 in 2023. You might remember we did actually cover that Base is one of the leaders in stablecoins as it stands right now for fees generated back in the month of June 2026. Both firms wanted control, custom features, and predictable economics without bootstrapping a new validator set, bridge, and liquidity base from scratch. Notably, neither firm launched a proprietary gas token. This is actually a big deal because if you are the owner of the blockchain, it means that you have the ability to determine what your gas token is. And if you can determine what a gas token is, why not make it your token that you're a primary holder of? Because, well, that would really pump your own bags. Pros and cons to that from the consumer standpoint. But if you're actually launching your own project, it makes a lot of sense to actually use your own token and then also be a massive beneficiary of when that token performs well. In this case, though, they actually just chose to build right on Ethereum and use Ethereum as the base token itself. Ethereum already pays for layer 1 services and carries deep liquidity and avoids the legal distribution questions a new token would raise. The product case is concrete. Robinhood says stock tokens now trade 24/7 through its wallet in more than 120 countries with a dedicated Uniswap venue live from day one. The Arbitrum Foundation puts the chain's latency at 100 milliseconds, basically 1/10 of a second. Those specifications require dedicated chain, but never a new layer 1. Early traction supports the choice. Within 2 weeks, the network passed Ethereum in volume across decentralized exchanges, ranking third roughly at about $811 million daily. That's nothing to shake a stick at, that's for sure. So, do we like Robinhood over here at Walk the Block? No. We, in fact, have made entire videos and included in our 101 section about which central exchanges we like. Robinhood is unfortunately not on that list, but we will tip the hat to them when we acknowledge that they have onboarded a lot of users both to traditional stock investing and also crypto. Additionally, Robinhood is available internationally, and it also opens up the rest of the world to being able to purchase stock. One of the notable things that Robinhood wants to do with this blockchain in particular is actually get into real world assets. In particular, they want to do tokenized stocks. Similar to what we saw over on Solana when it came to the SpaceX IPO, you were actually able to trade tokenized stock of SpaceX on Solana. They cleared over $300 million in the first 24 hours. And that's an indication that the volume and the demand is actually there for it. Because of that, it's a no-brainer to say that, yeah, other people can get in on the action. And, well, everyone's favorite degen trading platform, or at least the everyman's trading platform, as in Robinhood, they can get in on the action too. So, with that being said, I do want to talk about Robinhood a little bit more just to understand exactly how big they are in this space. So, did a little bit of research, trying to compare them to some traditional finance trading platforms, traditionally for stock, but now have actually evolved into the crypto space, whether it's through ETFs or actually offering the token spot to customers. Robinhood, they form $377 billion in total platform assets as of May 31st, 2026. Let's see. Charles Schwab. I don't know about you guys, but I remember seeing Charles Schwab commercials back in the day when I was like a teenager. Yes, I know I'm dating myself a little bit, but they were a pretty big one. They have $13.1 trillion in client assets. Fidelity, another large one that I actually use myself for the old 401k. They have $18 trillion in assets under administration. And Vanguard, another massive one out there, has 12 trillion in assets under management. So immediately looking at these numbers, the big boys are the big boys. They're in the trillions. Robinhood is at 0.4 trillion, not even a half a trillion yet. But here's where the big boon for them comes in. As far as customers and accounts go, Robinhood has 27.7 million funded customers and also reports 29 million investment accounts in some periods. Charles Schwab, 39.5 million active brokerage accounts. Fidelity, 50 to 57 million customers and individual investors, depending on how you count it. And Vanguard, 50 million as well. So that's a lot tighter of a race when it comes to the total number of accounts that are actually on there. As far as the amount of money in there, yes, a lot more people are going to have their money in these traditional brokerages just because of stuff like I mentioned previously. If you have a 401k, you have your own portfolio, odds are you're going to have it on one of those because it just existed long before Robinhood did. So when it comes to total dollars, it's going to take a large bridge to gap. And guess who has the most money tied up in these kinds of accounts? Yes, it's going to be the older generations because they've had their entire lives to save up in these accounts. And, well, Robinhood didn't exist back then. Therefore, they probably stuck with the guy that they had. And Robinhood just isn't used for that kind of stuff. So assets under management, yes, they definitely are being dwarfed in that competition. But when it comes to the actual amount of people, the number of people that use that product, Robinhood is actually competing with some of the big boys up here. And that is something that you kind of got to respect. So let's take it a step further. Let's see how they compare against central exchanges. Again, Robinhood, $377 billion in total platform assets. Coinbase, 294 to 376 billion in assets as of the Q1 and Q1 2026 figures. That actually means that Robinhood is technically bigger than Coinbase when it comes to total assets managed. That's kind of a crazy thing to think about, but at the same time, take your pick. What's more used? Robinhood for all the meme stock trading or Coinbase for all the crypto trading? These are both two very emerging industries of the last 5 years. I think we can all remember back to the good old GameStop days when DFV or Roaring Kitten was the one leading the charge with the massive short squeeze going on over there. But crypto at the same time was also performing fabulously, I will say, because that was 2021 and that was the year of a top. That's a pretty tight competition right there. So as far as Robinhood being a traditional stock player, not as much, a lot of users, but not the volume. When it comes to crypto, though, Robinhood, I think, has actually successfully bridged the gap between the average retail investor, the everyman, if you will, the guy that sees the GameStop story and wants to get in on it, and the average crypto user. I think that we're seeing kind of maybe even a lot of duplication across these accounts, which is odds are if you're a true DeFi native, you might have gotten your start on Robinhood and then ultimately switched over to being DeFi and then still using centralized exchanges like Coinbase, Kraken, Gemini, or others to help facilitate the in between going that direction. By the way, I do also have the numbers. Kraken had 16 billion tracked reserves in one analysis, so they are much smaller than Coinbase. I actually still do like that platform. I think Gemini is pretty good as well. I don't use that one personally, but do enjoy Kraken, and I think Gemini's. I'm glad to have them in the mix in the competition as well. So overall, that's what we're looking at. Again, users, Robinhood, 27 million users. Coinbase, this is actually where they take the W here. 120 million verified users globally. 8.2 million monthly transacting users, though. So the amount of people that have a Coinbase account, a lot higher. People using it on a daily basis, much lower. At the same time, though, verified users globally. That is the thing that shows the max amount of people that have been touching this. And because they're verified, it shows that these aren't ghost accounts. And keep in mind, Coinbase also has their special premium account platform as well. So if you don't want to pay transaction fees, that's something that you can do there. I would argue that a good chunk of the 8.2 million monthly transacting users are probably in there because if you can just overcome the amount of money spent to, make it worth your while to pay for the premium account, I imagine that's where that is. So overall, when it comes to Robinhood's size in this ecosystem, They're doing pretty good when it comes to TradFi. They got the user base. They don't have the volume of money or the assets. When it comes to crypto, they're actually a pretty decent competitor for a lot of the space, especially when it comes to the amount of money being managed and also the users. Granted, crypto does have DeFi, meaning that you are able to keep custody of your own tokens, which we do advocate for over here. Can't give financial advice, but we can actually at least advocate that being in control of your money is better than letting someone else be in control of your money. So Robinhood's a decent player. So the creation of this layer 2 blockchain, I think it's a good thing for the overall crypto industry. It's getting more people on chain, or it's at least getting more transactions on chain, which is going to register in the data. And it's going to be one step closer to going down the rabbit hole of being DeFi native and actually taking full control of your crypto, which at the end of the day, that was kind of always the ultimate goal. Alrighty. That's about enough for that one. Robinhood, not a big fan of the company, but them producing an L2, it's part of an ongoing trend, and it is actually a step in the direction of mass adoption. You might remember that word. We've been saying it for a while here. All right, next story. Here we go. Coming to us from Yahoo Finance and Stockwits, or Stocktwits. That's a hell of a name. Tom Lee says Ethereum needs more privacy before $100 trillion moves on chain. New startup aims to deliver it. Yes, this is the continuation of our Ethereum saga. This makes it 4 streams in a row that we were talking about Ethereum. And in this case, we actually get a bit of a quote from Tom Lee. We were saying it would be cool for him to maybe work together with Vitalik and at least have some friendly communications and, at least say nice things about each other. That was last week. And, well, guess what? We might have actually got that wish fulfilled. Bitmine, BMNR, that is Tom Lee's company, by the way, said on Tuesday that institutional grade privacy is a prerequisite for large scale asset migration to Ethereum, as the new engineering and research company ETH Systems was launched. Quote, the next $100 trillion of assets won't migrate on chain without it, Lee said, calling ETH Systems exactly the kind of foundational investment Bitmine is making to accelerate Ethereum's evolution as institutional infrastructure. All right, we're going to pause here real quick. If you remember, we were talking recently, we got the roadmap last week, and we also got the announcement of the split of the company. And the week before that, we also got the layoffs, the reduction in overall budget for the year, but also the announcement that they're going to be working in layers for the different groups, focusing on different things. Privacy was one of them. That was one of the big things that Vitalik tweeted out last week alongside the roadmap. Now we're seeing why it matters. I mean, granted, we kind of told you why it matters last week, but now we're getting Tom Lee, who is one of the biggest megaphones to actually speak it out to the system as well. Tom Lee's reach is going to be a lot different than ours here for obvious reasons, but also Tom Lee does have a bit of a direct connection to the older crowd who are notably not in crypto. Privacy is something that a lot of people concern themselves about, especially inside of the United States. It's a bit of a foundational value, if you will. And well, this is one of your biggest players in the space saying that, yeah, privacy is needed, and building on top of the announcement last week, which is a lot harder to read by Vitalik, but he was also saying privacy is going to be one of the big things built in Ethereum 3.0. So if Tom Lee's right, it means that once the privacy element is fulfilled, that could be the golden ticket to get a lot more money on chain. Granted, in my opinion, there's a lot of money coming on chain as it stands right now already, whether it's through people like Tom Lee and Bitmine or Sharplink Gaming. They're also mentioned in this article, by the way. Those guys are trying to buy and stake like 5% of the Ethereum supply each. That's a lot of money coming in. In addition, last cycle, we saw the Bitcoin ETFs go on an absolute tear. Well, people might be looking for the next best thing. And guess what? The Ethereum ETFs have been live since 2024. So those are also available as well. And if the attention and the demand is there, there's a very good logical train of thought that would indicate that, yeah, money will flow into the Ethereum ecosystem as well. We'll keep it going here. ETH Systems said it is anchor funded by Bitmine Emergence Technology. Sharplink, there you go. Ethereum co-founder Joe Lubin and other community backers. The company added that it was developing technology that enables banks, asset managers, and other regulated industries to conduct financial transactions on Ethereum at scale. Keep that word in mind, scale, because that's the L1, L2 thing we were talking about, without exposing sensitive information such as trade details or client identities. The company was founded by these guys, the team behind the Ethereum Foundation's Institutional Privacy Task Force. The founders are from the Ethereum Foundation, Goldman Sachs, and Status, where they helped build the privacy infrastructure that is now used throughout the entire Ethereum ecosystem. Bitmine's price was up more than 10% in morning trade. StockTwit's retail sentiment around Bitmine remained in the neutral zone, while chatter stayed at normal levels over the past day. eSystems is starting out with a year of open source work already published at ethsystems.org and relationships built directly with central banks, regulators, tier one banks, and asset managers, the company said. Institutions are already trying out stablecoins, tokenized assets, aka real world assets, and settlement on Ethereum. But the company said meaningful adoption is about more than just access to the network. eSystems will allow each party to transact each, excuse me, ETH systems will allow each party to a transaction to view only what they are permitted to see while retaining decentralization and security principles across the Ethereum blockchain. So that might sound familiar. This is pretty similar to what we talked about in the past as zero knowledge proofs. Zero knowledge proofs are a cryptographic way of verifying information without exposing information to the other party. That is one of the big ways that you can solve this privacy question when it comes to cryptocurrency, which is that because everything is stored on the blockchain, it means that there's a lot of data available. Encryption is the go between to make something readable and completely unreadable. At the same time, you want to know exactly what is going on in your transaction. So if you have a secure source and a secure encryption, such as a zero knowledge proof, then you can accurately and reliably know that even though you can't see the other player's cards, you understand that the action going on between you guys is still fair, verified, and exactly what you think it is. So, because of that, it means that privacy is going to be the thing that allows you to exist on this blockchain where all the data is publicly available forever as long as the blockchain is alive. But it will actually allow you to protect your own identity, protect the details of your transaction as well. And this is one of the things that will take crypto one step closer to kind of how you do it in the real world with privacy of your own, banking details and whatnot. I don't think people want their bank accounts published about how much money they have it in there because privacy is one of the things that allows just basic business to happen and you don't have to show everything to everybody. It's part of the reason why corporate espionage is a thing. And it also allows you to be able to operate your business and not have it exposed to competition. Because if your competition knew exactly what you were doing, they would just do that and then undercut you by X amount that would be required to capture all your sales pretty much. Overall, the main point that I'm getting at in this one is one, it's very cool to see Tom Lee and a handful of other folks launching ETH systems. And two, privacy is becoming more of a big deal. We talked about it last week saying that privacy is something we've seen as a trend, whether it's the privacy tokens like Zcash and Monero actually having fantastic runs when it comes to price action over the last year, pretty much. And well, we saw the retail investors rewarding the people that were doing privacy. Ethereum has announced that they're building privacy, haven't built it yet, got to wait and see, but that's a goal that they're reaching for. If it truly is one of the things that will capture demand as much as they're leading us to believe that it will be, this could be another big win for Ethereum and actually help them to retain that number 2 spot and even really get ahead of the rest of the competition. The rest of the competition, talking about other big layer 1 blockchains like Solana, Avalanche, all the rest, they are starting to close the gap a little bit. Ethereum has been the big dog at the table, at least the number 2 big dog, second to Bitcoin, obviously, because just of the size and the age and the maturity of the blockchain and the technology that has existed on it. When we had the merge, aka going to Ethereum 2.0, that was when we went from proof of work as the verification principle to proof of stake as the verification principle for the blockchain. That was a big move. We didn't quite see the price action result pump as a result of it, but at the same time, that was something that actually really fundamentally changed the crypto ecosystem. Because, well, if you're someone that was buying graphics cards to create binding rigs, well, those are no longer needed for it, pretty much. And thankfully, this is definitely hindsight now, but this is all well before the AI boom and potential bubble that we're in right now, which created massive demand for semiconductors, graphics cards, and other very technological components. So they didn't know it at the time, but Ethereum going to proof of stake was a big deal. If we actually go Ethereum 3.0 like they're proposing by the year 2030, yes, that is 4 years away. It's crazy to say. Well, 3.5 really. That could be the evolution that they need. And the timing of that actually lines up pretty well with the overall market cycle. Because if 4-year market cycle holds true when it comes to Bitcoin and the overall crypto market, it means that we should be expecting a top somewhere around September, October of 2029. Granted, their roadmap does go out to 2030, but they're going to be releasing features when they are available. I do anticipate that the quantum proof technology or quantum proof security is going to be one of the last things that gets rolled out because, well, quantum computing technology really just isn't here in the current day as it stands, and I don't think it's going to get there overnight. So, if that's the case, then it means that privacy and just base upgrades to Ethereum could come out well before that peak in 2029, and that could potentially be one of the things that really fuels the upcoming bull market in the next few years. Alrighty. I teased it at the beginning, but now let's get into it. I've been talking about these different layers that we got going on. We have layer 0, layer 1, layer 2. What does it all mean? Well, at the end of the day, your layer 1 pretty much is what you think of as the blockchain. It has all the software, a lot of the infrastructure, and a lot of the base programming that goes into it. You can build the projects directly on the layer 1 chains. That is going to be a lot of the stuff that you interact with, and honestly, a lot of what the largest things in the market are. The layer 2s, these are blockchains that are built on top of layer 1s because you don't have to do all the heavy lifting, all the programming, a lot of the infrastructure, a lot of the stuff that you would have to figure out on your own. It's already solved on the layer 1. Layer 2 exists and checks in every once in a while through verification blocks with that layer 1. So the layer 1 is tracking your layer 2, but you can operate on the layer 2 without having to use all of the data in the layer 1 inside of the individual blocks that get verified every so often on your blockchain. As a result of this, you do pay some fees to that layer 1, but overall, layer 2 blockchains actually capture over 90% of all gas fees that are spent on that blockchain. That means is that if you're operating the layer 2, the majority of the money is staying inside of your ecosystem. If you're operating the layer 1, you are getting some kickbacks for all that work and all the infrastructure that you host for all the layer 2s that are built on your chain. As a result of this, your layer 1 typically is going to be slower when it comes to transaction speed and block validation times than your layer 2. This means it allows your layer 2 to operate faster with cheaper gas fees and doesn't clog up the rest of the chain that's operating around it. Having layer 1s having layer 2s operate separately also means something similar for them. It means less transactions filling up individual blocks and kind of actually splitting that load. Granted, the load does have to come back together and merge at a certain point to validate the data, obviously, because that's how the blockchains work. But in general, it does mean that it's kind of cheaper gas fees for everybody. What does that mean for who loses in this one? Well, it means if you were hoping for higher gas fees so that you could collect on them, I'm looking at you, Ethereum Foundation. Yeah, it means that you're missing out on potential revenue that you could have had that now exists elsewhere and you are no longer able to capture as much of. At the end of the day, though, when it comes to the user experience, the overall user experience is improved by the layer 2s because it means that you get to operate faster, you pay less in fees, and everything stays relatively siloed. So if you really only care about certain things and there's a layer 2 that caters to you, well, odds are you're probably going to enjoy that experience. Alrighty, I do want to bring up some visuals here for you guys. Coming to us from the classic Investopedia. Layer 1 and Layer 2 blockchain scaling solutions. There's the word again, scaling. This really is one of the other big keys about why the Layer 2s exist. Because the Layer 1 blockchains do get full of data. And if they get full, you got to expand capacity or you got to increase the amount of fees. The layer 2s allow you to build horizontally outwards instead of all on top of this one block. And that's what it really does. As a result, that's why you get faster throughput, lower fees. So here's your overview. Layer 1 scaling solutions are changes made to a blockchain's programming that allow it to handle varying amounts of transactions. Layer 2 scaling solutions are programs, networks, or other blockchains that offload some of a primary chain's work, conduct it, and periodically send the data back to the layer 1 ready to be processed. So here's maybe one of your more important little parts of the article here. Your layer 0, that's your infrastructure. That is the blockchain that goes between blockchains. A lot of times we call these bridges, or they can be entire blockchains on their own. Layer 1, that is the bread and butter of crypto, probably exactly what you know. Bitcoin, Ethereum, those are both layer 1s. Pulse Chain is actually also a layer 1 that was built similar to Ethereum, but designed for faster throughput and less gas fees. Pulse chain is an example of trying to solve the scalability of a layer 1 without going to a layer 2, because it means less hoops to jump through, and you still have the ability to have a native token to that blockchain and use it to the benefit of people on it, the people that are running it, whatever it is. The layer 2, this is your networking layer, which facilitates communication between nodes and where off-chain scaling solutions connect. So you can build the layer 2 on top of the layer 1. On your layer 2, you can have all the great stuff that you know from any layer 1, talking like DeFi apps, all that kind of stuff. Even a lot of different projects, tokens, whatever you want. You can choose to have a native token as the gas for that one, or you can just choose to have the native gas token be the native gas token of your layer 1 that you are built on top of. So in the case of Robinhood, like we talked about previously, they chose to just use Ethereum for it. When it comes to other stuff like Pulse Chain, which basically tries to just be a layer 1, but just have better technology and infrastructure, they have Pulse, or the Pulse token, as their gas fee. There are layer 3 and layer 4 networks that are out there, but they're extremely far and few between. And the necessity for it just really doesn't exist in the current day and age, because pretty much every layer 2 solves the issue of a layer 1. You only need a layer 3, or God forbid, a layer 4, if you actually start experiencing a lot of the issues that you had on your layer 1 on your layer 2, which that is definitely a suffering from success kind of example, being that your layer 2, which was supposed to be scalable, got so massive that it no longer is scalable, and you need another layer to help figure that out. At that point, we are really playing the Russian nesting doll game, where you are getting deep on it. But at the same time, like I said, if you are at that point, hats off to you guys. You have done something right. The people want it, the people demand it. And I would argue you guys are probably raking in the money, and you might even be able to afford that layer 3. Layer 1 versus layer 2 scaling. Layer 1 scaling solutions typically involve actions taken on a primary blockchain, such as Bitcoin, Ethereum, Solana, to vary throughput depending on demand. Again, keep in mind the Pulse chain example. That's exactly what this is right here. It fits into it. You want a decentralized, you can either have smaller data packages, just more validators, shorter time in between, so you don't have to process as much data in particular. That's how you scale at a layer 1. You kind of have to change the fundamentals of the blockchain itself to accommodate all the existing traffic and volume that you have on it. Meanwhile, the layer 2 scaling solution, typically any solution created to integrate with a layer 1 blockchain like Bitcoin and offload much of the work it must do and do for that blockchain. Layer 2 scaling solution then sends transaction data back to the layer 1 blockchain to be validated and permanently stored on it. This frees up resources on the layer 1 blockchain, increasing its throughput and thus its ability to process an ever increasing number of transactions. Yes. So again, this is a bit of a reference I made earlier, which is that your layer 1, the time between block validation is typically going to be longer than your layer 2. Your layer 2 is designed to operate faster and quicker, so that you can take in more transactions, handle a lot of the data up there, but it still needs the backbone of the layer 1. It's not capable of handling all the transactions and all the data logging on its own. It gets sent back down to the layer 1 to be validated, so that between block number 1 and block number 2 on, we'll say, Ethereum in this case, it might be 6 seconds. So these two blocks capture all of the data. Your layer 2 could have a block literally every second, meaning that there are 6 blocks for every one on your between your layer 1 and your layer 2. Now, that does mean that every 6 seconds, pretty much on your layer 2, it does have to go validate down at the lower layer. But at the same time, a lot of the data and a lot of the storage and the compression and the calculations has already been completed at the layer 2 level. So you're just sending the data. You're not doing the actual work of the calculations and performing the processes necessary for it. That's how you get this scalability solution. And then we have the examples, which we've already gone through. And they also give us the classic. Is Ethereum layer 1 or layer 2? Ethereum is a primary blockchain made up of different programming layers, because it is commonly called a layer 1 blockchain because transactions are executed and confirmed on it. There you go. Is Solana layer 1? Solana is layer 1. Here's your bottom line. Layer 1 scaling solutions involve changes to a blockchain's programming or code that allow it to meet increased demand. Layer 2 scaling solutions involve blockchains or programs that process information for the Layer 1 blockchain, allowing it to meet increased activity levels while attacking the scaling issues differently. Both solutions attempt to increase a blockchain's ability to handle more transactions as it becomes more popular. That last sentence right there, that kind of is the whole reason for all this discussion right there. You can have a layer one that does have fast transactions and cheap gas fees. The downside is if you get more users, either of those might go away. So as a result, you got to figure out a way to expand on that, to get more users, make more people happy, get more volume on chain, more total volume locked, more tokens, more DeFi apps, all that kind of stuff. At a certain level, you either have to change the layer one blockchain itself, or you have to integrate another solution, which is the layer two ability. Neither one is incorrect. There are trade offs for everything. It just depends on what you're willing to do. Maybe trying to modify your layer one to handle more transactions or actually change some of the fundamental infrastructure. There's risk to it. It also change, and change is something that people don't like when it comes to their financial assets because you want your stuff to remain the same. You want your dollar today to be a dollar tomorrow, well, excluding inflation, all that stuff, but we'll rant about the Federal Reserve another day. And then a layer two, you might not be able to get people to transfer over to a layer two. Or you might want to keep everybody in the same ecosystem so that you feel like you still have this community and everything can talk to each other reliably. You can talk to each other between the layer one and layer two chains, but at the same time, it's kind of splitting the community. It's splitting the party for all my D&D folks out there. And look, could it be the most efficient answer sometimes? Yeah, it absolutely can. Are there downsides that are outside of just transaction time and gas fees? Also, yes. Trade-offs at the end of the day, that is what everything is ultimately. Alrighty, folks, that is pretty much all I got here for you tonight. I do want to say hello to some other folks. We got Taraftars saying, hi, buddy. Good morning. Good morning. Glad to see you. It is definitely evening over here at my time. Yeah, sun is definitely down now. So fortunately, we will not be practicing hockey outside tonight. A little bit past it. And then, yes, Moonpilled Rational Optics. I will see you on book club tomorrow. Yes, sir. I'm looking forward to it. We're covering The Theory of Money and Credit by Von Mises. Is going to be a classic macroeconomic book. I'm looking forward to it a lot, but that is going to be over on the DGen Roundtable. But you are here at Walk the Block. We're navigating digital finance together. And I got to say, we actually had a fantastic call earlier today with some of our members discussing pretty much any question that they had off the top of their head. And we had a great time doing it. It was good. It was detailed. And if you want to get your own questions answered outside of the stream here, you can head on over to walktheblockndf.com. That is where you can find our membership tab. And in there, you can sign up to get inside our private Telegram community. Inside of there, you're going to have access to all of our streams as they happen live and the entire video archive of all previous streams from the past. Talking about just basic market updates, fundamental research on stuff, and even some pretty basic and advanced topics that we go into regarding crypto strategies, technologies, all that kind of stuff. Anyways, around here, we like to say the waters get rough, so don't sail through them alone. Come join us as we navigate digital finance together, private mentorship, exclusive live streams, Q&A. Go from beginner to intermediate to expert with us. We all work together. We can all win together. Well, I do repeat myself now, but that is all we have here for you tonight. I was not expecting Ethereum Part 4 of the ongoing saga, but this was a minor update talking about the privacy stuff. But yeah, the big announcement here tonight was that Robinhood launched a chain. By all metrics, it appears to be successful. We'll have to see how reliable their network is, but because it's a layer 2 built on Ethereum, I imagine it's going to be pretty dang reliable. So hopefully they'll miss out on all the Solana downtime allegations. Outside of that, when it comes to the market, yep, sitting right around $63,000. We did break above our 50-day moving average, which is very exciting. But whether we stay above that, that's the big question. We're getting a bit long in the tooth when it comes to the cycle time. Currently sitting at about day 41, day 42, depending on which side of the Greenwich Mean Time line you are on. But overall, I happen to think that we're probably going to be heading down over the next 2 weeks. I know. Boo, Zenith, price go down. But that's just the way the cycles work. I don't make the markets. It's just market psychology. That's how it is. So we'll be keeping an eye on that. We also have the next Federal Reserve meeting coming up on the 29th. So your interest rate decision, probably going to be no change. But nonetheless, your interest rate decision is coming up then. And we're going to get a pretty cool press conference, the second one from our new chair of the Federal Reserve. So I will be breaking that down with you guys when that happens. But until then, we'll see you guys next week, Thursday, 9 p.m. Eastern time, as always. Apologies for a bit of the late show tonight. We had to get some stuff going behind the scenes. But that is all we got. We'll catch you guys inside of the private Telegram. Again, if you want to get there, walktheblockndf.com. But outside of that, we love seeing you guys here on YouTube. We will always be here for you, and we'll see you guys next week. With that being said, ladies and gentlemen, good night.